Thank you, Thomas. So my presentation today will focus on the dry freight market. I will discuss the drivers behind the market transformation we've experienced in 2021, as well as considering the outlook ahead with a particular focus on decarbonisation. So, as I said, the dry market has been transformed this year. We have seen a vaccine-powered recovery combined with fleet inefficiencies and to a transformation in market sentiment as rates climb higher. Now, vaccine-powered are the IMF's words, not ours, but we think they sort of summarise the general developments fairly well. So we have seen an industrial recovery in the world outside China with steel sector restocking and iron ore supply growth. We've had a second successive year of strong grain trade growth with a revival of US soybean and corn exports, plus Australian wheat, and followed by soybeans from Brazil. Now, the main demand driver here has been animal feed consumption in China, where the pig herds have been recovering after African swine fever. There have also been opportunities for longer haul coal trades for the US, Colombia, Black Sea, Russia, the Far East, China, India in particular. And significantly, Pacific activity for geared vessels has been very strong. For example, on Chinese cement trades, New Zealand logs, and iron ore from India to China. Now, these have combined with inefficiencies that have reduced the carrying capacity of the fleet. We have seen congestion at Chinese and Brazilian ports, and at the same time, COVID regulations mean vessels are being forced to divert for crew changes and for quarantining outside ports. It's extended the length of voyages. Now, meanwhile, an exceptionally strong container ship market and container shortages has pushed more cargoes onto bulkers. Now, at the same time, shipping is approaching a historic transition as a consequence of the drive towards decarbonisation, which I'll be picking up on later. So this first chart shows the Baltic Exchange dry bulk carrier time charter rates. These are dollar per day rates. And what is most apparent, first looking at this chart, is that it's cape sizes in the blue line that have had the most volatility. They've experienced a roller coaster ride so far this year, peaking at $44,817 a day on the 5th of May, and then dropping back to close to $20,000 a day only a month later. Now, however, also of significance is the sustained strength in earnings for smaller Panamax, Supramax, handy-sized vessels. Earnings for all these vessels are at or close to multi-year highs. Now, this chart covers the same time period as the previous, but it shows the dollar per ton Cape-size spot voyage rates. So these are weekly assessments by our brokers. They're calculated using the time charter rates, but also take into account additional factors such as bunker fuel costs and port charges. So again, these dollar per ton rates of iron ore and coal show the roller coaster ride that we've been on. So taking, for example, the Tubarão Rotterdam iron ore spot voyage rate in the red line, see this peaked close to $17 per ton in early May before dropping away sharply to current levels. So what does this mean for dry bulk trade volumes? So this chart here shows the annual change in total seaborne dry bulk trade. It's in million tons, the gold bars against the left axis. And at the same time, the IMF's estimates for global GDP growth in the dark blue line set against the right axis. So what we can see is that after contracting in 2020, this is primarily due to a fall in coal trade, dry bulk trade growth is surging ahead this year. So you've got expansion is being led by iron ore and grain trade. There's also been a return to growth in the coal trade, although volumes are expected to remain below 2019 levels. But overall, we're expecting the strongest annual growth in dry bulk trade in percentage terms in 8 years. Now, at the same time, growth in the dry bulk carrier fleet is showing. This chart has the 10,000 plus deadweight ton dry bulk carrier fleet by year of build. So the existing vessels in the blue, the order book in the red. And what is clearly apparent, if you look at 2021, is that even if everything on order is delivered, fleet additions will still fall year on year. Although we would not expect this to be the case, there will be some slippage of vessels from 2021 into subsequent years. Now, looking further to the right of the chart, we can see the current order book, those red bars, is very small. Actually represents just 6.3% of the trading fleet in deadweight tons at the time, at the moment. And this compares with a year ago level of 7.8%. So what is causing this reluctance of owners to order? Now, a key factor is uncertainty about the regulatory outlook. An owner ordering a vessel today needs to be confident that it can operate profitably, not just when the vessel is delivered in around 2 years' time, but also over the lifespan of the ship. Now, a significant factor in this is obviously the current transition decarbonisation agenda. So after the transformation in freight market fortunes this year, shipping is set for another transition as a consequence of decarbonisation. The IMO's Marine Environment Protection Committee is currently meeting to discuss this and other environmental issues. The IMO has 3 decarbonisation goals for shipping: to reduce the carbon intensity of vessels through the implementation of an energy efficiency design index, to reduce carbon emissions per transport work by at least 40% by 2030 compared to 2008 levels, and to reduce the total annual greenhouse gas emissions by at least 50% by 2050 compared to 2008. So what new measures have been agreed to meet these goals? So we have the Energy Efficiency Design Index, a design index for new building vessels. Phase 2 began in January 2020. An Energy Efficiency of Existing Ships Index, EEXI. This is to be introduced in January 2023. This is much like the EEDI, but for existing vessels in the fleet. And this aims to push forward new innovations. And there's also a carbon intensity indicator system, whereby vessels will be given an A to E rating of operational efficiency as of 2023. Now, vessels rated D for 3 consecutive years or E for 1 year will have to submit a mandatory corrective plan demonstrating how the required index rating of C or higher would be achieved. Now, however, crucially, there are currently a lack of clear penalties for non-compliance to these regulations, so making them far harder to enforce. Now, so what measures can vessels take to reduce their carbon emissions? This chart here shows a potential range of technical measures for CO2 abatement. So we have things such as air lubrication, propeller improvements, a speed reduction, or sort of hull maintenance. But what I think is significant looking at these is that with the exception of speed reductions, these measures only result in marginal improvements in CO2 emissions, so up to between 1% and 2%. And furthermore, some of these are already in use by vessels, so reducing the scope for further reductions. Now, one other option is to switch to low or zero carbon marine fuels. However, these present their own problems, as most have a much lower energy density than the heavy fuel oil in use now. So this chart here shows the required tank volume for alternative fuels compared with heavy fuel oil. So for example, ammonia to the right of the chart would require about 2.75 times the space as heavy fuel oil to obtain the same energy output. So as a result, A new vessel powered by alternative fuels such as ammonia would have to sacrifice cargo space to make way for larger fuel tanks or have more frequent bunkering calls compared to a vessel powered by heavy fuel oil. So looking at the fuels listed on the previous chart, what are the other challenges associated with them? Well, the big challenge for all of them really is investment in infrastructure, which marks the biggest cost. Now, LNG is relatively abundant and it probably has the easiest options for transitioning compared to the other fuels. Biofuels, they face competition for feedstock from other industries for supply. Methanol is mainly used by the chemical industry at the moment, so would require scaling up. Ammonia requires special equipment to maintain it at a low storage temperature. And then for hydrogen, storage is one of the main obstacles against its adoption as a fuel. It's the low energy density presents obstacles, and there are also safety concerns. So at the moment, LNG is really the only alternative fuel that's seen significant commercial uptake in the dry bulk sector. However, investment at the moment is primarily restricted to larger ships operating on dedicated routes, and it's been the major mining companies that have sort of spearheaded the investment in these new fuels. So, however, decarbonisation in shipping is not just on the agenda of the IMO. So other organisations are also taking interest as well. So the EU is set to add shipping to its emissions trading scheme from the 1st of January 2022. Now, it's currently unclear how any carbon allowances would be distributed amongst the shipping industry, what costs there will be, and or whether this will apply to just intra or also extra EU trade. Nevertheless, this demonstrates that actors outside the IMO can also shape the regulatory outlook for shipping and sort of adds to that uncertainty as to what the future will hold. So just to summarize, the dry bulk markets have been transformed in 2021. We've seen a rebound in trade growth driven by economic recovery and restocking in the global steel sector, sorted by grain cargoes and long-haul trade. Nevertheless, COVID risks do remain. There is also a crucial role for fleet inefficiencies in offsetting the negative impact on the freight market from net fleet growth, and longer term, there is an increasing focus on decarbonisation. Okay, thank you very much.